Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Monday. It is October 18th. And what do I always talk about Monday? I talk about the biggest threats and the biggest opportunities this week. So what do? Let's get into it right now. Now, the market's not going to open up for another 2 hours and 21 minutes or so. As you can see here, it's only 7:09 Eastern time. But I like to get this out to you guys as early as possible. I want you guys to have the latest info. So Dow Jones are down about 113 points. The Nasdaq is down 70 points. That is beyond random. Anything below 75 to 85 on the Dow or above 75, 85 on the Dow is beyond random. So the market is actually down today. In terms of the news this week, the biggest focus is going to be on homes, existing home sales, housing starts, housing market, and industrial production. So you're going to have some PMI, some industrial production, and jobless claim in manufacturing. Mostly industrial stocks and home sale stocks. That's what's in play right now. Now, as I mentioned, the market is down today, but we're down 0.39, but we did have 2 complete days above the 50-day moving average. But even with that said, I'm not as positive on this as I'd like to be because the range is so tight. I mean, look at these days. They're very, very little, and it didn't really give us a big idea of follow-through. So I would like to see a little more follow-through before getting bullish because to me, it feels like we're going to violate the 50-day moving average. And if we violate the 50-day moving average, we're going to be in the twilight zone, which is the area between the 50-day and the 200-day moving average. And when we're in that zone, the markets just don't do much. You get a lot of volatility. Sometimes you get little volatility, but you don't get a lot of directional trading action. So I want to make sure if you guys are going to go long, or I want to make sure before you guys go long or really go long, that we are in fact bullish. And if you look at the Dow Jones for bigger clues, you will see that we're pretty much in the same boat. But again, I'd like to see a little, I'm not 100% sure, just based on right now we're at 351. 351 is like right here. So we're still very, very close. And based on the choppiness action we've seen, and based on the fact that earnings are just starting out, I wouldn't put too much faith into a massive, massive rally. I would say at this point, we are still going to remain choppy. Now, I just showed you this report for the week. Again, some of the big reports for the week: existing home sales, manufacturing activity, Philadelphia Fed manufacturing. This is going to be big. The Fed manufacturing and industrial production are going to give us a good idea of how the bottleneck supply chains are impacting manufacturing and how it's impacting production, because you need a lot of parts for industrial production. So it's going to be a very interesting report that's coming out in less than 2 hours, about 15 minutes before the market opens. Pay attention to this report. It's going to set the tone for the remainder of the day, not the week, but the day. Now, news out of China. Again, not really unexpected, but China reported its economy grew at a meager 4.9%. That's not positive. And again, that could potentially reflect on our growth. Chinese growth is under pressure as the government seeks to limit energy use and reduce financial risk for reliance on debt-fueled property developments. Yeah, Evergrande, oy vey, and they're having a major coal shortage to a point where they have to get in bed with Australia again to get imported coal from Australia, because Australia and the United States are some of the biggest producers. China is not. So they're going to be cold this winter. Shortage of computer chips and other components due to the pandemic are hurting manufacturing. I want to see how it's hurting manufacturing. We're going to get chip companies and companies like Apple and Amazon reporting, and computer manufacturers letting us know the actual impact of it. The 4.9 annual pace of growth was slightly below the forecast. Not good. And compared with the 7.9 expansion in the previous quarter, which was exaggerated by the downturn as we had in 2020. I was about to say that before I saw it written here. Positive company earnings. So far, the numbers have been positive, and I'm expecting them to stay that way. A report showing people spend much more at U.S. retailers in September than we had expected. Remember, economy, U.S. economy, 2/3 of it is retail. And if these numbers stay up, that's a very, very positive sign for the economy. But it may be a sign that the Fed may take action faster than expected. The S&P is back within only 1.5% of its all-time highs. But again, as you guys saw, it's been very, very, very choppy, and it's still very, very questionable. Although internals are looking really solid. Again, I'm not as concerned that we're going to have a big downturn to the downside. I'm more concerned and scared with whether we're just going to remain choppy or go higher. I want you guys to understand that. A few weeks back, last week, the week before, we were concerned if we were going to crash. Now, it's not even close to being on the table. Now the question is, are we going to remain choppy and within the twilight zone, which is the difference between the 50 and the 200-day moving average, or are we going to rally? So I want to make sure you understand there's a big difference now of where we were versus where we are. Early indications are climbing, and earnings so far have been encouraging from bank stocks and financial companies. Now, looking at the bond market, you're going to have to pay attention to the bond market. If the reports, now the bond market is not as much under pressure now as it was last week to go higher, so there's a chance we may go lower. We currently have a bond position. I personally think we're going to kind of stay around this area, and I think the news may be slightly weaker than expected. If the news is weaker than expected, there's a good chance the bond market's going to go higher in the short term. In the long term, I'm looking for bonds to go lower. I know what I'm saying and what I'm doing seem contradictory to each other. But my reason for going long bonds was because I was afraid that I could be wrong and the market could have crashed, but it never did, and I didn't think it would. But when the market's vulnerable and it's approaching the 200-day moving average, it would be irresponsible of us not to have a bond position as a hedge. But right now, that position is not needed. We're down just a little bit. I'll see if we can maybe exit it for a scratch, or maybe we'll see some more upside. Or if the news starts getting negative, the bond market would rally. Why? Negative news says economy slow. If the economy is slow, then the Fed would have to think twice about withdrawing aid. If the economy is better than expected, then the Fed has a really good reason to withdraw aid. If they withdraw aid, less money comes pumping into the bond market every month. I want you guys to understand that. And remember, weaker bonds, higher rates, weaker bonds. So right now, with more questionable activity with China, we've got a lot of Fed data coming out, and industrial production. If it's weak, if housing starts are a little weaker than expected, it can cause a little buying in the bond market. Now, in terms of the two sectors you guys are going to be focused on this week, you've got XLI, which again is kind of vulnerable, but it is trading above the 50-day moving average, and we're pretty close to all-time highs, although we've been kind of choppy. So I'm not suggesting we're going to go down and crash. I'm just suggesting we may stay choppy for quite some time. So that's the first sector. The second sector, real estate. I like real estate right now. I like where it's at, but again, we're not even above the 50-day moving average. We're still in the twilight zone between the 50 and the 200-day moving average. I know you're not getting my sound effects, which I love to death. It's too early for the sound effects. We'll have to wait for the afternoon. But again, be careful and wait till we're above 2 days above the 50-day moving average. Looking at the sectors visually as a whole, these are all the sectors. The financials are looking really good. The energy is still looking really good. Technology looks like it's coming up. If we can get above the 157 level, we're smoking hot. Look at consumer discretionary. Did I tell you that this was going to happen, or did I tell you this was going to happen? Did I tell you consumer discretionary, the most speculative sector and the one that's highest to the S&P's? This is a very, very positive sign for retail sales, by the way. Very, very positive sign, because consumer discretionary is retail sales, right? Consumers discretionarily spending money. So, and that's looking good. But again, is China going to put a little pressure on it? Supply chain issues, bottlenecks, earnings, people not working. There's a lot of issues, but I do like consumer discretionary, and typically consumer discretionary pulls tech up with it. Healthcare, industrial looks pretty good. Basic materials looking a lot better. Real estate, Healthcare and real estate are Utilities, not really bullish. Consumer staples, and communication services. So staples and utilities are the most conservative, non-speculative sector. So the fact that they're is actually pretty good for the market. Overall, everything's looking pretty good. The fact that healthcare is sagging, the fact that communication's sagging, that's not so great. But again, it's all being outweighed by consumer discretionary. Looking at the QQQ, Let's see here. Again, it's the same song and dance. We're not even above the 50-day moving average on either days. So you got to be very, very careful. And in light of that, I've got three stocks that are potential short candidates, all right? Why? Because I think the market is still going to remain choppy. And again, are we bearish? Not even close. Are we choppy? There's a good chance we may stay choppy. Why? Well, put the call ratio within, look at that. This is the safety zone. I mean, we're right smack in the middle of it. So we're not bearish, we're not bullish, we're right in the middle. Volatility, let me show you volatility. We're way below 20. I mean, we're like right back down to where we should be. So everything, and the fact that consumer discretionary is rallying, the fact that the Russell 2000 is pulling the market higher, is all very, very bullish. But again, we're not out of danger zone yet. I mean, look at this. This is just a hair below the all-time highs. But the markets have been choppy, so it's not hard to get to all-time highs. The question is, are we going to start trending again? And so far, that's a big question mark. The fact that we're not going down, that we're not going to crash, that's almost a certainty at this point, almost, because everything is pointing to bullish or choppy trading action. But there's a big difference between a bear market and a choppy market. And with all the bullish market we've been seeing lately, over the last several years, getting a little choppy may not be out of the question. And we're in a choppy market. Strong bearish stocks do pretty well, and it gives you a good hedge. So here's what I've got for you. Flow services. Look at this. It made all-time highs back middle of the year. It's been going straight down. All the highs have been getting weaker. Look at that. Weaker. It's now between the 200-day and the 50-day moving average. The 50-day moving average is trading below the 200-day moving average. Looks like we bottomed out here. It looks like we're going to fill this gap and go lower. So if we start going lower, there's a good short here at the $36.70 level, all the way down to the $33 level. And if we start breaking above the 200-day moving average to the upside, you get out of the trade. That's one. Next stock. Universal Display. This stock was doing really, really well before the supply chain issues. Supply chain issues are hitting tech really, really hard right now. So again, it's going up. I don't know if it's got more upside. You may want to wait, but it looks like it's ready to turn lower. Again, lower highs. The highs have been just going weaker. We've been just going down, haven't been going higher. We broke down. The 50 days below the 200-day, the 20-day EMA, which I don't really use that much, is below the 50-day, and it looks like we're going to turn back down. We're at 176. I would say we're going to go down to 160, and if we go to the 50-day moving average, you get out. Last but not least, ACI Worldwide. Let's see what they do. I think they're shippers too, right? No, software company. Universal Payments Company. I see computer software as a prepackaged service. Look at the one-year return, 68%. Not doing all that great. And prepackaged software, again, markets are still choppy. And the NASDAQ, and this is a tech-related stock, is still below the 50-day moving average. I like this one. We're right at the 50-day moving average. The 200-day is above the 50-day. The 50-day is above the 20-day. That's what you want to see for your shorts. You want the 200 to be above the 50, 200, 50, 50 above the 20, and then pulling back to the 50-day line. Now, if we go up to the 33, 34 level here, I would get out, but it looks like we're going to revert back down. So even though the market's not really bearish right now, it's choppy. These trades, notice they've been going down, 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 down as the market has been going up. So they're neutral trades. And remember, when markets are choppy, you want to get in on both sides of that market. Now, I hope this gave you the biggest threats, the biggest opportunities. You got to watch out for industrial production, housing stocks, and jobless claims. We're going to have to keep our eye on the Russell 2000 and see if it remains above the 50-day moving average. The key is whether or not the NASDAQ is going to get above the 50-day moving average and stay there for 2 sessions. If it does, I think the SPY will go along with it and continue this rally. If not, there's a good chance we're going to go choppy again. And if we are, that's actually pretty darn good for the bond market. That's why I don't want to make too many decisions right now, because the bond market's kind of choppy. And usually bond markets, when they bottom out like this, like that, they tend to go higher. So again, that's the story, and I'm sticking to it. Now, and remember, we got FLS, OLED, and ACIW as a short or as a good hedge for this market. Now, folks, Tomorrow, we're going to talk about strongest sectors, strongest stock, weakest sector, and weakest stock. And maybe I'll even give you some actionable trades if you guys behave yourself and send me some nice love letters to support@marketgeeks.com telling me how much benefit you're getting out of these videos that I spent so much time doing in the morning just for you. And before I let you go, you need to pay attention to this. Pay attention and pay good attention. You probably know this, but most popular trading strategies that novice investors use, they lose money. Think about it. If you could simply Google a winning strategy, everyone would be making money, right? And remember, for every winner, there's a loser. Wall Street knows this, so they take the opposite side of those trades. In other words, they bet against the common strategies that many individual traders use on a daily basis. Now, it's controversial, but there's a way for us to take that knowledge and use it to our advantage. Unfair advantage, folks. It allows you to get into a trade often before big money traders pile in, right? Who wouldn't want to get into a trade before big money traders pile in? I sure would. Now, tomorrow, we're hosting a live training to give you all the details. But you've got to click on the link below to register before it's too late. Again, it's happening tomorrow, Tuesday at 1 p.m. Eastern Time. I'll get you all the details, but you got to follow the link to register before it's too late. Fade smart money. There's nothing like fading smart money. And as always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when I post my next video for you. And remember, FLS, OLED, ACIW could be good potential shorts for today. Make sure to like this video, subscribe to this channel if you're watching on YouTube. Stay ahead of this market. Be the first to be notified when I post my next video. And don't miss tomorrow's live event. I'm going live. Learn how professionals fade everyday traders and gain an edge doing it. This will give you a really good unfair advantage, in my opinion. You guys got to check it out. Follow the link below and have an amazing week ahead. And I want to hear from you. Support@marketgeeks.com. I want to hear if you're getting some benefit out of this. Bye, guys.